Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. Today, we're speaking with Dr. Wes Gray, founder of Alpha Architect, an asset management firm dedicated to an impact mission of empowering investors through education. He's a Marine, an academic, and a practicing financial professional. So I think he's got a lot of great insights, which we hope to be able to pluck out of his brain there. Wes, thanks for joining us.
Yeah, appreciate you having me, Ed.
Also joining me today is my guest host, Patrick Schramm. He's a regional vice president for the ETF channel on the East Coast and has worked with Wes before and has gotten to know his shop quite a bit. So I think he'll also offer some great perspective, not only on that, but on the ETF markets and investment markets in general. Hey, Pat.
Thanks for having me, Ed. Appreciate it. Great to be here.
So, maybe I can try to provide some context and from where we can start, and just for the average listener who might be listening to this at some different period of time. But, we're still early 2022. We started out 2022 in the markets pretty volatile. Markets are generally have taken a hit. You have a war in Ukraine, between Russia and Ukraine, all kinds of uncertainties. That's created in the macro economic landscape. You've had the Fed, who's gotten one interest rate hike under their belt and has laid out at least the potential for 6 more of varying degrees of magnitude. There's a lot going on. And I think one of the goals that I had wanted to touch on today, or at least try to tackle today, is, are we back at a time in the markets where fundamentals matter? And we spent the last decade or longer where fundamentals didn't seem to matter, and the markets just kept running and running and running despite valuations, despite earnings in some cases. And, Wes, through his shop at Alpha Architect, has a unique quantitative approach to value and some other factors like momentum and quality. Plus, they're also in the ETF business, both as a sponsor and a white label provider for others. I believe Wes has seen a ton of different ideas. We've seen a ton of different ideas for new product development. So I think we have a lot to cover, and I'm really thankful to have Wes on the show to try to tackle such a wide degree of topics. But, maybe one of the first places I'll start, Wes, is just with you and Alpha Architect. Maybe give us a little bit of background of Alpha Architect and why you decided to start it.
Well, why I decided to start it, looking back, is probably because I was crazy. But at the time, I just always loved investing. And I frankly always wanted to run an asset management shop. And a lot of people don't know this, but essentially the founding of our firm was started by a cold call. I was a professor, and some billionaire who actually read my blog and read my dissertation cold called me. And that's, that was 12 years ago now. But that's really what got us started, is I finally found a really rich person who could actually have capital to invest in us. I was able to grow the business. But long story short, what the heck do we do? You kind of hit on it. We really have 2 core businesses where on one of our businesses, we're really just a deep, geek research shop focused on delivering like concentrated factor exposures. And we do that via managed accounts and then our own ETFs. And then we also have another business, which is commonly referred to as ETF white label business, where essentially we sit back behind the scenes as the operational backbone for other people who want to launch ETFs, but they want to focus on like intellectual property, selling their ETF. They don't want to deal with all the fun action behind the scenes that you guys know very well, with legal, compliance, regulatory, all the fun things like taking out the garbage and cleaning windows behind the scenes that most people don't want to do. Well, we have a whole business dedicated to that as well. So we play all angles of the ETF business, essentially. So
you knew you always wanted to be in asset management or run an asset management shop?
I did. So I grew up pretty broke. I grew up on a cattle ranch, and this idea that you could make money off of money as opposed to digging ditches and bucking hay, I found that awesome. And back in the day, I had a steer. I made a few grand. I used to do 4-H. I don't know if you guys are familiar with that, but I made like a couple grand. And my grandmother, who's now passed now, she was a huge Warren Buffett fan. And because my dad didn't know anything about investing, he's like, hey, talk to Grandma Ginny. And then she this was at a young age. I was like, I don't know, 10 or 12 or something like that. And I invested that money. I think it was in like the Janus 20 fund, or it was one of these crazy, just dumb luck things where it wasn't really Warren Buffett-esque, but it happened to work out really well. It was in the 90s. And I was like, oh my God, like you could put your money and it makes more money. This is way better than working. And so I just always thought investing was really cool initially, just because, hey, it's the lazy man's way to get rich. And then over time, I became actually interested at a fundamental and intellectual level in investing, like the science, the art of it, which is, why I did a PhD and spent my whole life doing it. So, and hey, being an asset manager is like the epitome of being in the game. It was a matter of like, how would I ever get there? Because I didn't know a lot of rich people, and obviously to start an asset management firm, you need money to invest, which means you need to know and hang around rich people, which I didn't do at the time. But I got lucky, as I mentioned, and had a multi-billionaire give me a holler, almost 12 years ago. So all worked out.
Well, on that topic, Wes, I mean, you're, just pulling on the thread of your background a little bit more. I mean, you're a hard guy to offend, but I'm going to give it a try here off the bat. I mean,
good luck.
Yeah, here it comes. I'll put it bluntly. Like, what's with nerds taking over asset management? I mean, back when I graduated college 20 years ago, firms wanted the captain of the Duke lacrosse team, right? Goldman Sachs and all the hedge funds.
Yeah.
Now they want the guy he picks on, right? Who writes algorithms and codes, right? The quantitative world. So I'd love to hear your take on what's changed, and maybe as a follow on to that, like what advice would you give to a young person coming out of college looking to enter this industry today?
Yeah. Let me give you a quick narrative of how I came to be a quant. Like obviously I grew up, I was like captain of the football team at 160 pounds. I was from that world. I was in the Marines, all that good stuff, right? Like, I never picked on nerds because I was always a hidden nerd. I just never told people I was into gaming and everything. But so I played the card of like, all right, be tough, rah, rah, rah. So I've kind of been on all sides of that fence. And long story short, going way back, I was always a stock picker initially because I just found it very fun, right? And through my own personal investment career, I ended up getting my face ripped off, way too many times, ate a lot of humble pie, and eventually went to, work on my PhD and hang out at the University of Chicago. And I just quickly realized that all the data, all the evidence suggests that for most strategies in the marketplace, you can access their benefits by just using systematic approaches. So instead of beating your head against the wall, wasting all your time, wasting all your effort, if you can get 95% of the way there with a computer, why wouldn't you do that? So I think what's happened is there's been a huge move towards systematic and quant and away from discretionary. And for me personally, that's just how my narrative arc worked out. But that doesn't mean that I think that discretionary investing is something that's going to go the way of the dodo bird. I think it's just going to come up to personal preference. I still actually believe that if you're really, really deep in the weeds, you have ironclad discipline, you have an extraordinary capability to kind of manage your own behavioral bias problems, you can be a great discretionary investor and you don't have to be a coder. I really do believe that. So even though I think that on average that you should probably invest time learning Python and get really good with technology because most of the jobs are going to be there, most opportunities are going to be there, and those are the skill sets that you probably need. That's not to say that someone who's just dead set on being like a discretionary stock picker or macro person, you can't be successful. It's just, there'll be a path for you as well. You just got to make sure that you're really passionate about it, you stick to it, and you have a real clear mind, and you're able to defend against behavioral bias problems, which unfortunately learned the hard way. I am not. So that's why I'm a quant. I don't trust myself, but other people might be able to trust themselves a little bit better.
At least you've recognized that. I think that one of the biggest obstacles that people have is not recognizing that in themselves and having overconfidence. And
Yes. And I think it's unfortunate, and maybe because we're the graybeards now, but I keep seeing the same thing happen, right? Because I grew up, my big bubble was the 99 internet bubble. And then of course, like the housing bubble. And then here up until recently, we had like these go-go tech stocks and Bitcoin, all these other things. And you always see the same psychology where people come out to get so excited, fundamentals don't matter, these things could go to infinity, and they actually believe it. And you're just like, no, that's not how the world works. Like, money does not grow on trees. It's not easy. You can't go 100% all in on anything and expect to survive. And yet it seems like every 10, 20 years, there's a new episode of just, I don't know, sucker born every minute, but people just want to believe in fairy tales. And it must be part of the human condition. I'm not really sure.
Did you ever start doubting yourself over the last decade or so? I feel like that condition or that environment just went on for years and years and years, much longer than I thought it would.
I kind of have probably some mental problems where I just don't really care that much about what other people think or do. If I believe in a process, and I think it's grounded in first principles, and it's grounded in human psychology. And if my perspective is literally 20-year horizon, which most people say, but they don't actually have, like, if anything, everything I've seen in the marketplace over the last 10 years just reinforces everything I already believe in, which is actually bad for overconfidence. But ironically, like, even though a lot of things that we do, like on one hand, like value investing is a good example, have quote unquote not worked, it's not surprising either, given the backdrop of sentiment, the psychology that's in the marketplace, because we've seen this rodeo happen before, and we will see it again at some point in the future. It's just, it all comes in waves. And as long as humans are involved, I don't see a lot changing in the investment landscape. It's all details.
I'd love to talk a little bit more about your approach. You've written books on quantitative value, quantitative momentum. I think you also have a strategy, quantitative quality. Do you think the environment today, do you think that it's the perfect environment for the types of strategies that you offer?
I'd say, unfortunately, yes, right? So usually I'm a big buyer, more and more a buyer, that the markets are driven by flows versus fundamentals, at least these days. And so usually the things that have totally stunk, i.e. factor investing, trend following, like pretty much all the stuff that we do, has had terrible runs to just, hey, go buy S&P 500, do nothing else, and you will have crushed the world, right? And because that psychology of like, well, why would you do anything else except just buy U.S. mega cap stocks that are free in infinite quality, and Vanguard can deliver that? Why would you do anything else, right? So that kind of psychology usually sets the world up for actually the cycle to shift into things that everyone hates and everyone thought was a loser process to start working again. I can't time when that'll happen, but long story short, and of course this is self-serving because this is what we do, but I do believe that like good old-fashioned strategic factor investing, buying cheap stocks, buying winners, and we're big fans of trend following as well. I think those three concepts are evergreen. And if you look in the deep history archive and you get back to first principles, and you have 20-year horizon, there's no reason why they wouldn't be as good as they've been in the past as they will be in the future. It's just obviously in the short window here of time that the market looks at, these strategies have not been in favor. But I actually find that bullish, right? I don't want Larry Fink and everyone, shouting from the mountaintops like, hey, factor investing is awesome. I actually like what's happening right now. Hey, go buy thematics, go buy ESG, go buy whatever, because now it's just less, less people in my business. Whereas, as you guys probably know, like 10 years ago or even 5 years ago, like factors were all the rage. Now everyone thinks factors are stupid, which I actually think is awesome, because we're going to be in factors for the next 30 or 40 years, no matter what. And so I don't have a problem with it, even though, we haven't been really cool recently. I think they'll be good going forward.
I love the way you guys, define factors, in your own way, right? You haven't the index providers feel like the federal government in a lot of ways, right? They write and enforce these arbitrary rules. They tax our returns with their fees embedded in the index, and you guys, look at things very differently, right? Versus like a Fama French type approach. Talk to us a little bit about that, how you think about that.
Yeah, sure. So the basic idea here is, I never was in the business, right? I've never been in institutional investments. I was in the Marines, and then I did a PhD, and then all I knew was research and programming. And I was like, I need to invest my own money. Let's build products that are evidence-based, tied with academic research, and I'd put my own money in. And so I was never clouded by the industry. And what I've learned is the industry doesn't care about what the academic papers actually say or actually do. They care about benchmark hugging and closet indexing. So every single product out there, the primary focus is on how do we track this benchmark, not how do we make money in an evidence-based long-term way, right? Example, if we go look at an academic paper on like something like value, what do all the academic papers out there that study value basically do? They go look at portfolios where they say, hey, there's PE ratio or something, right? We're going to go look at how the top decile, or say the top 10% cheapest on PE do relative to the 10% most expensive. Oh, wow. Over the last 100 years, if you run a portfolio like that, you make a ton of money. And you could say, well, let's just look at the long leg. Okay, if you just buy the top 10% cheapest, annually rebalance it, you beat the index over the last 100 years. So one would logically think that if you wanted to do that strategy, you would make the portfolio look kind of like that, right? You're going to go rank stocks on PE ratio and buy the top 10%. That is not what index providers do. What index providers do is they say, hey, we're tracking the S&P 500. We need to be within 1% of that index every year. So we're automatically going to start off where, okay, there's 30 stocks in the energy sector. We have to own 30 stocks. And all we can do is tilt away plus or minus a little bit, so on and so forth. In short, they're not doing what academic research that documents the outperformance does. What they're doing is they're benchmark hugging with noise. And so the whole mission of what we do and why we write those books is we said, let's just go through the deep dive on all the academic research with full transparency. You could go replicate everything we do. It's an open secret, and we're going to try to build strategies that are as close to the academic research designs as possible, but also make sure that they're practical. Because there are some issues, obviously, with academic research or portfolio designs that aren't implementable in practice. So we want to make it where you can actually invest in them. However, we have zero concern for career risk or benchmark hugging. Frankly, don't give a you-know-what about it. And what we're going to do is that's what our differentiation is going to be, right? We don't care about career risk. We don't care about tracking error. We don't care about benchmark hugging. We care about beating the benchmark over the long haul. And that's what we're going to do, and that's our edge. And we could tell everyone in the world about it because all the other asset managers aren't stupid enough to do what we do, right? Because they need to raise hundreds of billions of dollars and placate the demands of investors who are benchmark huggers, where we just need to carve out a unique batch of the investment public out there who actually has the ability to look past, the last quarter or year and think on a 20-year horizon. So that's what we do. It's not secret sauce. We just knowingly do things that unfortunately suck. But that's is what it is, right? That's the whole edge. If it was easy, everybody would do it and everyone would take advantage of it. But and I could tell everyone exactly what we do and our secret sauce, and I already know, other people will not be dedicated to that mission because it's too hard to follow. It's really that simple.
It almost sounds like you're doing like smaller portfolios, which would allow you to have more active risk.
Yeah. So what we do is one of the craziest things, you guys probably know this, but Fama was one of my advisors when I was at Chicago, and he's like the famous guy or whatever, right? And so they have this paper, Fama French 92, for the life of me, I've never understood this, right? They use book to market to measure the value of a company. Makes no sense to me. And even today, if you go look at like book to market based portfolios, 30%, 20-30% of the companies that these things own don't even make money. They don't even have positive net income. And I came out of old school stock pick and Ben Graham style stuff where, hey, the whole point of value investing is you actually need to make money to be a value in the first place. Just because you have a lot of book value, if you're losing your ass on the income statement or cash flow statement, well, that's not what world is that value investing, right? Anyways, long story short, the world got anchored on book to market as like the quote unquote value metric. And of course, what happened? All the value benchmarks anchor on book to market. So no one ever stepped back and said, well, why are we using book to market? It makes no economic sense. It doesn't capture intangibles. It doesn't even capture earnings power, frankly, outside of like banks and insurance companies. Why do they do it? Because the benchmark does it, right? So everyone's focused on that because that's what the benchmark does. As I said in the beginning, we don't care about what the benchmark does. We're trying to make money over the next 20 years and beat the benchmark, but we're not trying to beat it in like some short window because we don't care about it. And so we step back and think first principles. What do I care about as a value investor? Well, what I care about is how much money does this operating enterprise make? It's called operating income, right? So we focus on operating income or EBIT, which is literally like any business owner 101 would understand, right? You take the revenue, you minus the cost of goods sold, you minus the SG&A, right? So what are you making and what do you sell it for? Minus the cost of making the widget, minus the cost to keep the lights on and pay the employees to sell the crap. That's your operating income. Great. I should focus on that because that's what this business generates. The main point is when we think about value investing, we're thinking about it through the lens of like a fundamental like business owner or a private equity owner. And private equity people use the same ratios that we use to assess value. They don't use book to market. But the industry uses book to market because that's what all the benchmarks use. If you're doing what we do, we obviously have massive noise around the benchmarks because we don't use book to market. And book to market is a very different way of assessing value than like the kind of techniques that we do. The other major difference, I know, Pat, we've talked a lot about this, and it goes directly again to benchmark hugging and career risk, is I always ask people, okay, you believe in value investing, right? You think that buying cheap stocks earns higher returns over the long haul. Okay, why is the value fund you own have the same PE as the market? And second question is, how is that value investing? If you're gonna value invest and you think that cheap stocks drive excess returns, that means you have to own cheap stocks. Duh. Right? And so how do you own cheap stocks? Well, if you have 1,000 securities and you buy the top 500 cheapest, you still own a lot of expensive stocks, right? If you want to own the cheapest stocks, you got to own the cheapest stocks. So go focus in like the top decile or the top 50 or the top 100 or whatever you want to do. But that's where you need to be because in order to capture the value premium or the value return or any of these factors, the portfolio itself has to reflect the characteristic you're trying to go after. And the number one mechanism in which you can use to achieve that is concentration, right? Concentrate in holding a portfolio of the things you actually want and less of the things that you really don't want. And that simple idea of just holding concentrated exposure to the characteristic you want, it's so obvious to normal people, but it's not. It's also obvious to geeks and quant people. But the problem is when they go to the CEO and the CEO says, "Well, that's cool, dude. How does that look relative to the index every quarter, every year?" And you're like, "Well, it actually looks terrible a lot of the times." They're like, "Well, we're not doing that. Moving on. Go do the benchmark closet index version for me, please." That's what happens in our industry is people say that they want to deliver, some characteristic or some factor, but all you got to do is look at the characteristics of the portfolio and they're lying, right? Or the construction of it. Like it is what it is. And that's what we do basically. We just deliver the pure good that people want or think they want. And then we just got to educate them and inform them that the trade-offs that come with going with that approach and the reason why other people don't do it. And we always tell people, hey, it's simple, but it's not easy.
Maybe we can transition a little bit to talk about your ETF white label business. I got to imagine you, like us at Van Eck as well, have seen tons of different ideas. How do you tell somebody what they are presenting to you is not what they think it is, or not as great as they think it is?
Well, we never say that because you never want to destroy someone's ego. Essentially, what we tell people on the white label side is I don't want to be real judgy about their investment process because I understand there's different segments, different buyers out there. We just ask them some fundamental questions. Are you passionate about this idea? Like, do you really believe in this? Do you invest your own capital? Are you going to be that maniac at the conference or at the advisor where it's just, this is like a force of nature. Like, this person will not stop shutting up. I guess I got to listen to it, right? So you got to have the passion for the idea, which is important. And then the other important things are, do you have the capital to back this for 5 years? Because the reality of, regardless of your idea, if you can't stick this out, be in the marketplace and grind it out every day, you will not be successful unless you get really lucky. The third thing is, can you sell this idea, right? Like, as a white label provider, I'm a shovel salesperson where my role is not to distribute and market your product. That's your job. My job is to get you to market as affordably and efficiently as possible so you can access the global marketplace with tax efficiency and all the good stuff we love about ETFs. But you have to sell it, not me. Hey, if you're backtest, I do tell a lot of people, hey, just so you know, that has zero value add, and I could do that in my sleep, like in 5 minutes, and you think it's worth, 50 bips or whatever, great. I don't believe you, but as I said, are you really passionate about it? Do you have a ton of operating capital to stick to it? And do you think you can sell it to someone? Because maybe there is a specific segment or buyer that, for whatever reason, likes your product. That's cool, right? I don't judge on the white label side. Our business there is to help people win. And it's not my baby, it's your baby. I'm just providing the carriage. I'm providing the support. I'm like the nurse, right? Like, nurses don't see a new baby and say, God, your baby's ugly as shit. The nurse always says, this is a beautiful baby. I'll help you take care of it. Here's how you nurse the baby. Here's how you take care of it. That's what we do on the white label side. I'm not here to judge how beautiful the baby is at some level.
It seems like a lot of ETF entrepreneurs, if you will, see the quick success of similar themes or, hot trends. And they think, like, to your point, I'm going to launch this thing. I've invented plutonium. The first 100 million is going to come in the first week.
Yeah.
And, and the reality is the success rate is probably similar to picking, pink sheet stocks, right? It's like, 1 out of 5, 1 out of 10. How do you think about being first versus better when you're talking to ETF entrepreneurs? And how do you sort of square that with them?
Yeah, I think it boils down to, like, a good example would be like Perth Toll, who launched like this Freedom Fund, which just now, I've known this, like, she's been telling me about this for 10 years. And she spent 5 years talking to everyone in the industry about, like, hey, we should freedom weight emerging markets. And everyone blew her off. Like, this is such a stupid idea. Like, now everyone says it's a genius idea. But remember, she's been thinking about this for 10 years. And then she finally barely convinced us to launch this thing 3 years ago because I was a Marine. I just liked the idea. So I was like, all right, let's do this. I loved her passion. She's like the most passionate person ever about this new, unique idea. And she had operating capital, and I just believed in her. And so she had all these like characteristics of what we just talked about, where I think this could be a success. And the other part of being a success, can you grind this out every single day for 5 years and make zero money? And yes, she could. And now is her moment, right? Now, all of a sudden, this Freedom Fund is like blowing up. We get, she's going to have the biggest fund on our platform, and she's getting like crates like every day. It's crazy. But she had to wait that out, not just for the 3 years it's been around, but also the prior 7 of trying to like get someone to launch this thing, right? So as you said, like, a lot of people see these things as like, oh, it's so successful and amazing, but they don't realize it could have been 10 years behind the scenes to get there. I think it's really important that first to market is great, but it's really, really important that you be able to grind for 5 years, have the passion, have the operating capital to see it through. And then second to market is okay, But now you got to compete on price, and you also got to have all these other characteristics. So first to market with passion, belief, and funding and time, I think is always best, but that's obviously the hardest road to hoe too. So
how hard is distribution for some of these providers?
Well, so it's extremely hard, and we obviously can't compete against VanEck, iShares, and Invesco because I'm not sitting on piles of money and what have you, right? So we have to do distribution smarter, not harder. So for boutiques, I say, listen, if you want to be in the game of hiring more wholesalers, outbidding the AdWords, doing all the stuff that the corporate guys do, you're never going to win. You got to do guerrilla warfare. You got to go to where they can't go. They're not going to do Twitter and social media because their compliance officer is going to be like, yeah, right, it takes 10 years to approve that post, right? You got to go to areas where the big guys can't compete effectively. So going underground, staying under like the 0 to 500 mil independent RIAs who are decision makers that no one wants to talk to because they don't got enough AUM. Well, guess what? Those guys go from 10 mil to 50 mil to 500 mil. But you got to be friends with them when they're small, right? And so we just tell these boutiques like, hey, be in for 5 years, leverage scalable distribution platforms, so LinkedIn, social media, earned media, go to the conferences and focus on those buyers who can make decisions but don't have 50 committees. Yeah, they don't got a lot of assets under management, but if you're with them in the early days and they're growing, you'll be growing with them, right? Because that's the only place you could compete. Like iShares is not going to waste time talking to some advisor with 100 million AUM, right? Why would they do that? It's like, they may have like some small employee that goes talk to them. They're going to go talk to the guy that has 10 billion AUM and send a whole team over there, right? Whereas a boutique, $100 million advisor, if you have 0 AUM in your fund, I might get 1 mil AUM from this person, right? 1 mil, if you're a boutique, is epic. 1 mil to like bigger people is like, that's a rounding error and a waste of my time. You got to be a warrior, man. You got to be like David, and you're facing Goliath, and you got to take that culture of like, hey, we're going to be hungry. We're going to take pennies where the other guys left the penny on the ground. And so we just try to coach them up in that culture, and it works. Like that's why you see these funds on our platform. They start small and they just keep growing slow and steady. They build their brands. They're in it to win it. But it's just a long game type thing.
I'd love for you to give us maybe a couple minutes on March for the Fallen and what's going on there.
March for the Fallen is just like it sounds like. We're going to march for the fallen. So what it was created, I think it's about 10 years. 10 years ago as it started. We've been doing it for the last 7 or 8. And essentially what March for the Fallen is, it's a not-for-profit, not a fundraising event. It's a direct-to-consumer charity where your effort out on this march is the charitable contribution. Because the concept here is that Gold Star family members, who are people that had a loved one die in combat operations, so unfortunately you become a Gold Star family, now the parents, the siblings, they have to live with this their whole life. And I've seen it happen way too many times where like a parent has to bury their child, whether it's in like a military context or not. And I really think that's the worst thing that could possibly happen to any human being. And so March for the Fallen is just an opportunity to go recognize and let Gold Star family members know that, hey, we still remember your child. We remember their sacrifice, and we're not going to let them go to the wayside. I don't know what we're going to do this year, but it's always at the end of September. And, if you want to do the hardcore version, it's a 28-mile ruck march, but it's not about that. It's about putting in your best effort. So we've had, people that are 70 years old, Vietnam vets, do 5 miles on one leg. Hey, that's also marching for the fallen. What it's all about is just doing your best effort to represent and let that Gold Star family member know that, we still remember their sacrifice to the country and what their loved ones gave for freedom and all that good stuff.
That's great. It sounds like a really cool event. How can people find out more about it? Is it just marchforthefallen.com? Or?
Yeah. If you just go to, just go to our website, alphaarchitect.com/MFTF, or just Google March for the Fallen. There's a broader event that the National Guard manages, but they're not great at technology and management because they're focused on war fighting. And so if you're in the financial service industry, it's just a lot easier if you just go through us because we can kind of herd the cats and coordinate a lot easier. It keep you up to date, keep you informed, tell you what to do. And I think it's like $35, and that goes to the National Guard because for the events they give you a T-shirt, and on the live event, they got all kinds of like snacks and juices and everything. And of course, if you just want to do it remotely, we also host a deal. It's just a technology platform. But if you want to be a leader, like in your city, and you want to rally up 5-10 people that want to represent, that's obviously free. We just serve as like a central source for coordination, where you say, hey, I'm going to go do my event in the middle of nowhere in Iowa. We have a decent platform and reach out there where we could try to go identify, well, who else is out in the middle of nowhere, Iowa, that want to march for the fallen? And then you go represent with your buddies out there. And we try to coordinate it where everyone does it at the same time during the main event, again, in late September, basically.
Excellent. As we start to close out, we've talked about current trends in the market. I'd love to get your take on longer term trends that you see playing out over the next several years. It could be about what we've talked about, or it could be about something else that's really just kind of top of mind for you.
Yeah, I mean, I think the long term trends that I see in my little small world, and we're already seeing a little bit, but I do think that the whole value investing is a dog forever mantra it already is ending, but I think it'll become very clear that will certainly be ending over the next 10 years. I just see value, which is, just broadly more focused on fundamentals, cash flows. What have you done for me lately versus, hey, we've got this company that has amazing growth and our revenue costs are more than the free cash flow that could ever be generated by it. Pay us 50,000 times revenue to sales for this company. That just is over in my mind. I feel like discipline is returning to the market. And when discipline returns to the market, valuation matters again. And I think value investing will benefit from that, at least from a relative perspective. But that's not really anything new. Cliff Asness been saying that for, 5-10 years now. So now I'm on the bandwagon because I feel it is at the extremes where, geez, like even I'm convinced it's got too crazy. And I usually kind of hold out to like the very end. But now I'm on the boat too. But who knows? I'd probably be wrong. And then the only other thing, just again, in our world, is I see big movements in ETF world. Ever since I got clarity on the tax deal that they're not going to eliminate the tax benefit of ETFs, we are seeing literally a tornado or a hurricane, whatever you want to call it, of people that want to get into the ETF wrapper via SMA, mutual fund conversions. Like there is just the whole market of asset management, as we've all been predicting, because we've all been in the business. We know the benefits of it. Now, all of a sudden, you're seeing the old school players. They're very aggressively saying, you know what? We have to have an ETF strategy. And even though all the pundits and all of us have been calling this for 10 years now and been dead wrong, I really do believe that you're going to start seeing that tidal wave come to the ETF market. And everyone is going to be in the ETF business in the next 5 years. By everyone, I mean the big mainstream asset managers and people that traditionally have kind of said the ETFs are for, losers that don't like to make money.
Yeah, you see it happening. Yeah. All right. So we do a speed round called Trend or Fad. Pat and I are going to ask you about a few different topics or concepts, and you can answer trend or fad.
All right.
I'll start with a couple. NFTs.
Fad.
Okay. TikTok.
Trend.
Metaverse.
I'm going to say fad.
Psilocybin and psychedelics moving into mainstream medical use cases.
Trend.
Oh, yeah. Right.
Huge trend. Yeah, massive. You should look at the research on PTSD. I just know a lot about it from like the military side. I think it's a miracle, man. I think that's a huge trend.
How about cryptocurrencies, trend or fad?
I think it's probably a trend, actually.
And one I thought was interesting when we did our prep call that Pat mentioned, return stacking, trend or fad?
Trend. Unless the Fed keeps raising interest rates, then leverage starts to get more costly. But right now, it definitely I would say trend, but that's contingent on interest rate levels.
So I got to admit, I hadn't heard of that term until we did our prep call, but it sounds a little like the old portable alpha, right? Is it kind of like that?
Yes.
Okay.
Yeah, return stacking is basically leverage and hoping and praying that correlations don't go to 1. You can wrap it in as much fancy math and bullshit you want, but in the end, that's what it is. We're going to use leverage to get more exposure to more assets, and the reason we can use leverage is because the hope is that we believe we've built this portfolio so solidly that when the shit hits the fan, correlations don't go to 1. But of course, going back to first principles, if you have leverage plus everything goes in the tank, it's not return stacking. It's called return face ripping. So I just think that people should, and we do it. So I mean, I don't have nothing against it, but I just like when people do things that they go in with eyes wide open and not, via a marketing lens. So I would just tell people to be wary and investigate why the free lunch, quote unquote, is there. Because it's not a free lunch. It's just you're eating a tail risk you probably didn't know about.
And then I'll close with one more, which is moving to warm climate, tax-friendly jurisdictions. Trend or fad?
Hey, man. I don't know if one person's a trend, but I'm a buyer. I love it. As I tell people, I literally, I don't get paid for this. I think Puerto Rico in particular is the biggest arbitrage on the planet Earth. I love it, man. It's not perfect. Nothing is, but the people are great. The culture's great. The temperature's great. And honestly, the taxes are amazing. So I think it's all good. I think it's a trend.
Well, this has been great, Wes. Really appreciate your time and your insights. Best way for people to follow you, learn more about your business?
alphaarchitect.com, and then on Twitter, just @alphaarchitect. Those are probably the two easiest.
Awesome. And Patrick, thank you for guest hosting with me.
My pleasure. Thanks for having me, Ed.
Well, thanks, gents. And thank you for tuning in to another episode of Trends with Benefits.